I think that there's a lot more to it than just what the mainstream is trying to talk about. You sent me an article today that talked about the gold prices fell by 5.7% and making it the largest one-day drop in since 2013. And they call it a 4.5 sigma move. In other words, such a large move happens in one out of only 240,000 days in a normal world. What we saw in that kind of a drop is highly unusual. And when you realize it was dumped at the most inopportune time to create this type of sigma event, it starts to reek of desperation.
Andy Schectman, president of Miles Franklin Precious Metals, has been one of the most outspoken voices on the current state of the gold and silver markets. His analysis paints a sobering yet compelling picture of a financial system under immense strain, where the cracks are becoming increasingly difficult to hide. Schectman argues that the recent movements in gold and silver are not merely the result of market speculation, but rather signs of deep structural stress within the global monetary system. Schectman frequently emphasizes that gold and silver are no longer just commodities, they are becoming strategic assets. He points to the aggressive accumulation of gold by central banks around the world, especially in nations like China, Russia, and India, as evidence that the global power structure is shifting away from US dollar dominance. According to him, these moves are deliberate and long-term in nature, suggesting that the world's largest institutions are preparing for a future monetary reset. He warns that when the dust settles, those holding physical gold and silver will stand on solid ground, while paper assets and fiat currencies face severe devaluation. In Schectman's view, silver is the most undervalued asset on the planet. He notes that the gold-to-silver ratio, which historically hovers around 15:1, remains grossly distorted at over 80:1, a signal that silver is deeply underpriced relative to gold. Beyond its role as a monetary metal, Schectman highlights silver's critical role in modern industry, from solar panels and electronics to electric vehicles, arguing that the metal's dual nature as both an industrial and monetary asset creates an explosive setup for future gains. Before we dive into the interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
But the bottom line is, I think what we take away from this is that there were some big players who scooped up. And is it scooping up physical to cover short positions below 50, below moving averages, or at least below trend lines? And I think that's actually possible, because what we see is the buying of, in the last 3 days, by Morgan Stanley, 196,200 ounces, by his estimation, in the last 3 days of gold. So, when you talk about knocking the paper price down to create the lowest or worst possible settlement to drive the price down, and then buyers coming in to scoop up, I mean, that just reeks of coordination, of suppression, of a ulterior motive, rather than doing it the way any normal person would do, and that would be to slowly sell your position to maximize the return, instead of the antithesis, what we saw.
Again, a lot to dissect there, Andy, but if they bought it up, wouldn't we see, a rally, or did that just prevent it from falling?
No, we did see a rally. I mean, we saw it turn around tremendously. If you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up. And gold pared back roughly half of its losses. So there was some of that involved, but again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals, that a lot of these funds will be automated by black box trading systems, where levels are breached, they immediately trigger sell stops. And that's what would have happened. So a lot of people were sold out of their positions while they slept at night. And those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming.
Okay, and you're saying this was both gold and silver and done for effect.
Absolutely.
What would that effect be? What would that agenda be?
Well, that's a good point. What is it? And again, some of that would go in line with what we are being told, the conventional wisdom. Look, what matters? Supply is still tight. Central banks are still buying. Nothing's changed. Debt, wars, money printing, it is all continuing. And maybe when you take a look at what's happening around, a government shutdown, being criticized by the UK for the problem with our banks and the fragility within it. Problems again that are starting to creep up in the repo market. Gold's getting noticed by Reuters and Bloomberg, and all of this commentary shedding a light on gold. At the same time, things are a mess here in the United States to a degree that I think perhaps maybe the players that have ulterior motives, whether that be to continue to accumulate or whatever their reasons were, I guess to me, it's we're not going to really know, because all I can tell you is that it's as illogical as wearing a parka in Death Valley in July to dump that kind of metal onto the market at the most inopportune time, and it was done specifically, I think, to create an effect. Yet at the same time, what is the motive? What is the motivation? Is it the U.S. government coming in and really not wanting the light to be shown upon gold at that level because they're still trying to accumulate it, or other entities, other banks that are getting margin called, looking at severe stress in the London market, trying to drive the paper price down to protect themselves, to cover their positions? We could pick a million reasons why it's happening, but to me, the why is less relevant, as is the how it happened. And in any of these instances, if any of these players wanted to do things legitimately, it wouldn't have been done the way that it was done. It was done to rattle the market. And maybe it was to, the retail investor. Over the last several weeks, I was just in Aruba for 8 days. I never saw the ocean for more than 30 minutes because we were working nonstop. Business has been accelerating tremendously. It's starting to catch the eye of the mainstream and of the public. Maybe that's not what they wanted to see. This was a flush. Now, at the same time, look, a flush, you could argue, would have been inevitable after 9 weeks of going straight up and moving in a way that freaked a lot of people out. Never seen anything like this. But to your point, gold is no longer overbought as it was since late August, which is a good sign. It hasn't quite yet reached oversold, but what's interesting, silver has also confirmed an uptrend. Both of them have been an uptrend of a 200-day moving average, both of them continuing up. We haven't seen lower lows yet, but what we see with silver now is that it has already nearly reached its oversold levels. And that's, something very bullish, a technical indicator that should say that maybe the flush in silver has stopped, and in the short term, we should expect it to rebound. We could see a little more weakness in gold because even though both are no longer overbought, silver technically is no longer oversold. Gold, not quite there yet. So from a technical standpoint, sure, there is some merit in what the mainstream says. The application of how it came about is flawed, and to not bring that up is only telling half a story. And I think that's the part that the mainstream really is divisive about, and why so many people never understand what's happening, because they hear what they're saying and there's logic to it, but if they understood how it was actually implemented, they might look at it with a cross eye.
Schectman also draws attention to what he calls a two-tiered market, one for paper, silver traded on the COMEX, and another for physical silver in private hands. He has repeatedly warned that the paper market's leverage is unsustainable, with far more ounces traded on paper than exist in real physical supply. According to his analysis, when the inevitable disconnect occurs, prices could surge violently as investors and institutions scramble to obtain actual metal. This divergence, he says, will expose the long-standing manipulation that has suppressed prices for decades. Another key element of Schectman's analysis is the loss of trust in Western financial institutions. He argues that, as nations in the East continue to repatriate their gold and form trade alliances outside of the dollar system, the Western banking model built on credit, debt, and paper promises will lose its foundation. Schectman predicts that once confidence breaks in the dollar, investors will rush toward tangible assets like gold and silver in a desperate bid for preservation, driving prices to levels few can currently imagine.
I think that there's a lot more to it than just what the mainstream is trying to talk about. You sent me an article today that talked about the gold prices fell by 5.7% and making it the largest one-day drop in since 2013. And they call it a 4.5 sigma move. In other words, such a large move happens in one out of only 240,000 days in a normal world. What we saw in that kind of a drop is highly unusual. And when you realize it was dumped at the most inopportune time to create this type of sigma event, it starts to reek of desperation. Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, someone that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He was just told, he says, I was just told that 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai Metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him. To me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators, and a lot of them didn't own gold; they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery, and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation, knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical. And maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold.
The next phase of the global financial cycle appears destined to favor gold and silver in ways not seen for generations. As governments struggle under the weight of record debt and central banks continue printing currency to sustain fragile economies, confidence in the fiat money system is eroding rapidly. Inflation may appear to cool temporarily, but structural pressures, including geopolitical instability, de-dollarization, and declining global trust in Western financial institutions, are pushing investors toward tangible stores of value. In this unfolding landscape, gold and silver are no longer seen merely as commodities. They are returning to their historic role as the foundation of real wealth and monetary stability. Central banks, particularly in Asia and the Middle East, are accumulating gold at a record pace, quietly preparing for a world less dependent on the US dollar. This trend signals a structural shift in the international financial order, a transition away from paper-based promises toward assets that carry intrinsic, enduring value. Meanwhile, silver's story could be even more dramatic. With its dual role as both a precious and industrial metal, silver is facing unprecedented strain. Demand from sectors like solar energy, electric vehicles, and advanced technology is soaring, while global mining output struggles to keep up. These tightening fundamentals suggest a supply crunch is inevitable, one that could drive silver's price above $100 and possibly toward $200 in the years ahead. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.